Hello, everyone, and welcome to the Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head the G10 FX strategy team sitting here in the US, and I'll be your host today. And we are just coming off of a very big couple of weeks of US economic data that was really punctuated by an inflation print that was released this morning as we record on Thursday morning. And to break all of this down, I'm very happy to be joined by Kevin Cummins, who's our chief US economist here at NatWest. Kevin, thanks very much for joining.
Yeah, thanks for having me, Brian. It's an exciting day.
Yeah, for sure. I think it's a very exciting day for the Fed and the Fed chair, considering just how much progress we seem to have gotten in this CPI print. So I want to start there, Kevin. We just had the CPI release this morning, came in slightly weaker than expected. What's your takeaway on this CPI print, and what are some of the underlying details? Do you think the markets are right to interpret this as good news for the Fed and for the economy?
I think, in addition to it coming a little softer than expected, the underlying details of the report were encouraging. So I think, sometimes with data, the headlines could signal one thing, but when you dive into the weeds, you could see something else. But I think, looking through the numbers and some of the components and something like, for example, within shelter, hotel rates were weak, and the OER, which obviously, in addition to residential rent, makes up 40% of the core CPI. Those numbers were really encouraging, and without getting too bogged down into not seasonally adjusted data, some of the regional rent data were very encouraging. And I think in our forecast, this has been something that the Fed has talked about. Not only Chair Powell, but others on the committee have talked about how important it is that they see rent prices coming down, given the weight of rents. And I think today's news, not only did we see the headlines come down, but those rent measures were only up 0.3 on a month-to-month basis. And some of the regional breakdowns were really encouraging. So we saw an unwind in the Northeast, and I know I don't want to get too caught up in some of the month-to-month readings of not seasonally adjusted data, but that particular region showed a spike in May. We were hoping it would come off in June, and indeed it did. And some of the other regions around the country were also encouraging, that it's lending support to our view that eventually we'll start to see more convincing evidence that rents are moving in that direction of softer prints later in this third quarter. And that'll keep inflation moving lower, given their important weight within the core. So net, this was as good as a report as you could get, not only with the headline coming down 0.1, but also the core having to round up to 0.1. I mean, we were a little bit below consensus, thinking that we'd round down to 0.1. It barely rounded up to 0.1. It was 0.065. So that was very encouraging, and the year-on-year surprisingly ticked down another 10th. It's probably not going to happen over the course of the next few months because of base effects. So this time last year, we had really mild readings that are going to drop out of that calculation. So it makes for a kind of a difficult comparison, that those year-over-year numbers may remain a little stickier over the course of the next few months. But the implications, for example, from this report to the Fed's preferred measure of inflation are really encouraging. So, we'll refine our number tomorrow after the PPI data, because that's part of what goes into adding up the PCE data. But the core CPI implications for the core PCE suggested that our number, which was 0.16 on an unrounded basis, so a soft 0.2, gets now looks like it's a 0.077 going into tomorrow's PPI data. So that's encouraging as well. As not only is it happening on the CPI side, but a lot of that's going to carry through to the PCE.
I think this was, if the print we got last month, the May number that was released in mid-June, I think it was probably right to say that that was the best CPI that we've seen in several years in terms of progress on inflation. And this one beat that number, I think, was even better. So we now have 2 consecutive months of really good inflation numbers. But I want to ask you, maybe step back a little bit from inflation and talk a little bit about the labor market, because one thing we heard from Chair Powell this week, who spoke in Congress, was making the point that we've seen a cooling in the labor market, cooling, significant cooling in his words, and also that inflation is no longer, or at least it's not, the only risk we face. One of the big lines coming from Powell's testimony. So I wanted to ask you a bit about the labor market and his and Powell's description of the labor market. Do you think we might have further cooling here in the U.S. labor market?
I do. We're only on the start of it. And obviously, if you look at something like payroll growth, 206,000, that's more than sufficient enough to keep the unemployment rate at least stable, if not put some downward pressure on it. So I wouldn't overemphasize the amount of slowing that we've seen in payrolls, but those can change pretty quickly. So it wouldn't be surprising if the economy is downshifting more than the general view is, that those payroll numbers start to unravel pretty quickly if that's the case, if we're headed for a downturn. Not to say that that's what we're necessarily going to get, but that's certainly a risk here. It does seem to that the data this year, after revisions and after more complete data, have signaled that consumer spending has downshifted this year. The revisions to Q1 GDP were consistently down. Q2 seems to be tracking somewhere in the neighborhood of 1.5% to 2%, which obviously is down from last year's 3% plus rate, with consumption somewhere in the neighborhood of close to a little bit below 3%. Now that seems to be like the trend in consumer spending seems to be about 1.5% or so. So it's not collapsing, but if the labor market does show more evidence of some cracks here, I think it's what Powell has really emphasized this past week is that in the wake of the June employment report, which showed an uptick in the unemployment rate, albeit it was only barely rounded up to 4.1, it was 4.05 on an unrounded basis, but the directional signal has moved up 0.7 from the trough. So you don't normally see the unemployment rate. And I should caveat that that's just the trough and the monthly reading versus where you are now. But if you look at it, it's about 0.5 percentage point or so. Usually that doesn't move up 0.5% without more evidence of slowing in the broader economy. And I think that's the delicate balance that Powell is sounding maybe a little bit more dovish than what the Fed came out of the June meeting. Now, obviously, the dot plot in June was very balanced from, only a couple more members looked for 2 or 1 cut this year relative to 2. There were 4 that said no cuts this year. But, so it was pretty close call. But it was a decision to show only 1, and which is, a little bit more on the hawkish side than I think, including ourselves, expected going into that that employment report, I think, caught their eye in that if the unemployment rate is going higher, inflation seems to be moving back down. I mean, the jury is still out and the debate is still out. If now, are we getting an unwind of the exaggerated, perhaps, strength we saw in the beginning of the year? I mean, if you look at the core CPI, as we touched on before, January, February, March, you were up 0.4 on the month. April, May, and June, you're up 0.3, 0.2, and now 0.1, barely 0.1. So maybe that, seasonality in the wake of COVID, those seasonal factors were a little too, distorted at the beginning of the year, that you're kind of getting an unwind, and maybe the trend is somewhere in between. I mean, July and August, for what it's worth, we're assuming that we get more of a 0.2 like increase in the core. But it's hard to look at today's report and not be pretty encouraged that we're getting closer. I mean, if you look at like the 3-month annualized rate of change in inflation, this morning's core CPI, you're only up 2.1. That's even better than we thought. Last month in May, you were up 3.3. So you've made a pretty dramatic increase. And it's not shocking because you're dropping out one of those 0.4s and you're replacing it with barely a 0.1. So, those 3-month numbers do bounce around a little bit, but it's definitely in the right direction from the Fed. And this is the more confidence that they need to see. The labor data with that tick in the unemployment rate, I think it's right for Powell to say, hey, like we're making progress. We're not there yet. If you look at like the 6-month annualized rate of change in the core CPI today, you're at 3.3. So you're down from 3.7 in May. You're at 3.3 in June, but that's still obviously above their 2% objective. So I think we're getting there, and maybe the market really ran with the news today that it is a very encouraging report. But it needs to be on a sustained basis over the next couple of months, I think. So, while it's tempting, our own forecast, full disclosure, is that they wouldn't cut rates until December. This increases the odds that we could possibly see it in September. But the Fed really has a lot of time on their hands between now and that September meeting. Don't forget, there is a meeting at the end of July. The odds of them cutting at July, I think, are very low still. You could see a dovish descent in favor of an ease. That's a possibility, but I mean, that's just a guess. But for September, they'll have 2 employment reports, they'll have 2 CPI reports, they'll have 2 PCE reports. They won't have the August PCE, which they'll get later in September. I think the September FOMC is on September 18th. At the end of that month, they'll have the August PCE data. So they'll have a lot more, evidence of whether or not the economy is slowing with those employment data, or if inflation is indeed moving back to that 2% objective. They won't, unfortunately, have the annual revision to GDP that we'll get at the end of September. We'll get annual revisions that will incorporate revisions to PCE. So that's one level of uncertainty they won't have in September. And then obviously it's election season. So there's that, storyline which Fed Chair Powell very much said, well, we're data driven. We're not going to be influenced by the election. But if it's a close call, do they want to raise the possibility of any confusion in the general public of, favoring one candidate over another? So, there's that level of uncertainty there as well. But, at that September meeting, relative to today, they'll have a lot more information on the outlook for the economy, on inflation, and the labor market. But the news has been pretty encouraging from today's CPI, and as well as the May inflation data for sure.
I think that's right. Really interesting, thinking about it from a market perspective, that the markets have sort of been operating in a year of extremes as regards the Fed, right? Because we came into 2024 expecting, the market pricing significant interest rate cuts, significant slowing on the back of some of that weakness in inflation we saw at the end of 2023. We swung all the way back, priced out almost all of that easing in the first quarter as those inflation numbers came in stronger, right? And the market, as recently as late April, was talking about the prospect of, is the Fed going to have to put hikes back on the table? So that was late April. And here we are in mid-July, and we're right back in the camp of potentially easing the policy rate. As you mentioned, as soon as September, markets are now pricing 80% odds roughly of a cut at the September meeting. And there's even some expectation creeping up a little bit that there might be as many as 3 cuts this year. And so the market has really been fluctuating between these extremes. And I think you're right, Kevin, to highlight that the Fed themselves have been much more stoic. Their message has really been relatively unchanged throughout all of this, where they've sort of been preaching caution, preaching needing to see more data. And I think it's right to be, especially that seasonal factor that you mentioned, that 3 months of strong CPI to start the year, 3 months of weaker CPI more recently. At what point does the Fed say that we've seen enough data to be very confident that the first quarter was an aberration? Market seems to think that we've reached that point today. I wonder if the Fed is at that point as well. Maybe the big game changer in that side would be not just the CPI, but also those labor market data, because at every iteration of CPI, the slower we get in the job market, the more confidence I think the Fed will have. And so I think it's right to say that there's still plenty of time before the September meeting, that this probably shouldn't lock anything in. But I think a lot of extra eyes on that July decision and on Chair Powell, who I think is speaking next week on the 15th, if I have that right, about the possibility of putting a move in September, maybe a bit more firmly on the table. So we've covered a lot of ground here today, Kevin. I think we should stop it there. So I want to thank you very much for joining and really giving us a comprehensive breakdown of all of the data here in the U.S. and how that informs on the Fed, which of course, is really a big driver for a lot of foreign exchange markets. The Fed has sort of been one of the last hawkish dominoes in G10 FX. They've been one of the more hawkish central banks. The markets are sort of seeing that changing a little bit. That obviously has significant implications for FX markets. And so for our listeners as well, thank you very much for joining. And if you enjoy this podcast, please consider liking it and subscribing to our channel so that you can get our content the moment it's released. Thank you very much.